We're analyzing McKesson, stock ticker MCK, to see if it's a great business on sale. This analysis is about 10 minutes. It's going to be intense, but it's going to be worth it. Right now, McKesson's a small position in Berkshire Hathaway's public stock portfolio. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for McKesson. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing McKesson for your stock portfolio. Before we get into these valuable metrics, let's understand McKesson's stock performance. Right now, McKesson trades for $414.73 per share. They're at their all-time highs. Year to date, their stock price is up 11%. In the last 5 years, McKesson's beating the market. Their stock price is up 205% overall. They're compounding at 25% annually. In the last 10 years, McKesson's compounding at 13% annually. Going back prior to the global financial crisis, in the last 18 years, McKesson's stock price is compounding at 14% annually. In the last 2 decades, their stock is up more than 13 times. McKesson trades just $5 below their all-time highs. The company is up $100 from their 52-week low. Just over 1% of their shares are sold short. McKesson is a big business. They have a $56 billion market cap. But the burning question is, why should we be paying close attention to McKesson, and why is it in Berkshire Hathaway's stock portfolio? McKesson Corp is one of 3 leading pharmaceutical wholesalers in the United States, engaged in sourcing and distributing branded, generic, and specialty pharmaceutical products to retail chain pharmacies, independent pharmacies, mail-order pharmacies, hospital networks, and healthcare providers. Along with AmerisourceBergen and Cardinal Health, the 3 account for over 90% of the U.S. pharmaceutical wholesale industry. Outside of the United States, McKesson engages in pharmaceutical wholesale and distribution in Canada. Additionally, the company supplies medical surgical products and equipment to healthcare facilities and provides a variety of technology solutions for pharmacies. McKesson can trace its roots all the way back till 1833. It's headquartered in Irvine, Texas. Now that we have this understanding, let's get into the numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. A typical business earns 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based off the quality of the business. McKesson's returns on capital have really skyrocketed throughout this time. They've been above average in all 5 of these years and have been increasing. In their last year, they earned 62% returns on capital. These high returns have a lot to do with how the company's reducing their share count, which we'll look at later. In a given year over this time, McKesson earns 30.5% average returns on capital. That's more than 4 times better than a typical business. This is a huge check on metric number 1. Metric number 2, we're looking for revenue, net income, and free cash flow growth to support their high returns on capital. All 3 need to be up for this to be a check. In this time, McKesson's grown their revenues by 29%. The company's net incomes are up big. They were negative in 2021 due to a large $7 billion payout for a legal settlement. McKesson's free cash flows have also increased over this time. They've grown by 32% and they've been very positive in all 5 years. All 3 of these are up. This is steady growth for McKesson. Another check on metric number 2. Metric number 3 is where McKesson really shines. We want to see earnings per share growth in the last 5 years. We just learned their earnings are up big over this time. Very importantly, McKesson's bought back 28% of their shares outstanding. These are monstrous buybacks, absolutely huge compared to the vast majority of businesses. When you purchase a share of stock, you're buying a fractional ownership percentage in that underlying business. When a company buys back its shares by decreasing the number they have outstanding, they're increasing your ownership, increases the percentage of the business's profits you're entitled to without you having to spend a dime. Ultimately, it depends where the company buys back shares compared to their intrinsic value as to whether this creates or destroys value for shareholders. Either way, McKesson's dramatically reduced their share count. They've returned capital to shareholders through these buybacks. Plus, with their earnings growth, this is very strong earnings per share growth. This is our 3rd check of the day on metric number 3. Metric number 4, we're looking for something similar. We want to see 5-year free cash flow per share growth. We learned earlier that their cash flows have grown by 32%. Due to their share buybacks, their cash flows per share have almost doubled over this time. This is the power of a company growing and buying back shares at the same time. Another check here on metric number 4 means we're perfect through our first 4 metrics. But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets McKesson apart, which is having these without using a lot of debt. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in the last 5 years. McKesson's reduced their net debt position over this time. Right now they have $2.6 billion in net debt. When we add up their cash flows, McKesson's produced $20.5 billion worth of free cash flow. That's more than 8 times their net debt position. This is a huge check on metric number 5. McKesson generates a lot of free cash flow and uses very reasonable and very modest amounts of debt in their business. Another check means we're still perfect on McKesson. Does McKesson have what it takes to go a perfect 6 for 6 on our analysis and be a select 6 stock? We'll find out right after our bonus. As our bonus, we're looking at McKesson's dividend profile. Right now, McKesson pays a small 0.52% dividend yield. We want McKesson's dividends to be supported by their free cash flows. McKesson has grown their dividends per share in all 5 years. They've also grown their free cash flows per share by quite a bit. McKesson's easily supported their dividends using their free cash flows. They also pay out a very small dividend ratio. While this is a snapshot of their last 5 years and it's no guarantee for the future, McKesson's dividends are supported by their cash flows. They've looked very healthy in their past and they seem to be very healthy right now. This is a check on our bonus. Now let's get into our valuation methods. The big metric of them all, metric number 6, we want McKesson's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury, which is Warren Buffett's preferred benchmark. It's the first of 2 ways we'll be estimating a fair value for McKesson. Right now, McKesson has a $59 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at McKesson similar to it being a private business. In the last 5 years, we learned McKesson generated $20.5 billion worth of free cash flow, meaning in an average year, they produce about $4.1 billion of free cash flow. When that's divided by their $59 billion enterprise value, we get a 6.9% average free cash flow to enterprise value yield for McKesson. On a current basis, McKesson's produced $4.8 billion of free cash flow in their last 12 months. When that's divided by their $59 billion enterprise value, it gives us an 8.1% current free cash flow to enterprise value yield. Both of these are coming in above the yield of the 10-year treasury. They're above the risk premium we'd be looking for as well, meaning McKesson has done it all the way on metric number 6 here. This is a check. McKesson's a perfect select 6 stock. This doesn't mean you just run out and go buy the business. This is a starting point. We also need to estimate their fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze McKesson, which takes us on to using a discounted cash flow model to estimate McKesson's fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of McKesson's free cash flows from their last 3 fiscal years, then using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not for the business. Assuming McKesson grows their average 3-year free cash flows at 12% annually for the next decade. Then in the following decade, if this growth rate is cut in half and they grow at 6% annually, we won't be adding in their tangible book value, as that's skewed based off how the accounting's done for their huge share buybacks. If we're seeking a 15% rate of return, which is what Warren Buffett's looking for, assuming McKesson's valuations stay the same, an estimate of their fair value per share is around $374. That's down $40 from the company's current stock price. It's well within their range of where they've traded in the last 52 weeks. This fair value was also above where someone at Berkshire Hathaway was buying into McKesson. Please be mindful, McKesson's not been that predictable in their past. That could also impact their future and affect our assumptions. This discount rate is an estimate of total returns to shareholders based off their free cash flows. It's already including their modest dividend yield. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a moment, we'll give our final rating to McKesson, but we have to address something first. We've covered the numbers, but the qualitative factors of McKesson may be even more important. What are they? Looking at the factors supporting a potential long thesis, number 1, technology advancements continue to improve McKesson's performance and present new opportunities for wholesalers. Number 2, the direct-to-store model, which delivers drugs directly to each retailer's stores, for distributors are increasingly becoming more popular among retailers. In 2017, it represented 93% of sales, which was up from 74% just in 2007. This further solidifies McKesson's role in the pharmaceutical supply chain. Number 3, McKesson distributes pharmaceutical products to nearly 1/3 of the industry, leading to substantial negotiation leverage with generic drug manufacturers. We'd be remiss if we didn't cover the negative aspects of the business as well, looking at the factors supporting a potential short thesis. Number 1, pharmacy distribution through mail service has increased quickly. This could affect the customers that McKesson serves, potentially acting as a headwind for its growth. Number 2, scrutiny from the public and politicians over exorbitant branded and specialty drug list prices could result in lower price inflation long term, slowing McKesson's top-line growth. Number 3, reimbursement pressures on pharmacy and provider customers have led to an emphasis on cost containment, pressuring McKesson's profitability. There you have it for a balanced perspective in some of the qualitative factors of the business. Now it's time for our rating. In analyzing McKesson, stock ticker MCK, the business was perfect on our Select 6 analysis. They also checked out on our bonus, supporting a growing dividend yield maintaining a very small dividend payout ratio. It's worth reiterating this is not financial advice. When we performed our discounted cash flow analysis, using today's valuations and those assumptions, if you want a 15% rate of return, an estimate of McKesson's fair value per share is around $374. McKesson traded at those levels in May of 2023, well within where it traded in the last 52 weeks. Again, someone at Berkshire bought into the business at a much lower price than that estimate of their fair value. Looking at all the factors of our analysis, McKesson looks like an excellent candidate for further research. Again, this is not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about McKesson, and let me know what business to look at next in the comments below. Thanks for learning about McKesson with me, and have a great day.